Good afternoon. We'll just give it a few minutes for other people to join in, and maybe we can start, say, around 12:05. Let me just give it 1 or 2 more minutes before we start. So, our usual standard format will follow. In the sense, we'll have the presentation running for a while, and towards the end of the session, we'll have some time that's dedicated to Q&A. So, as and when you have questions, please feel free to type them into the chat box or into the Q&A section in Teams. And accordingly, we'll take in all of your questions at that point. So before we begin, I'd like to wish everyone a happy Dashera or Vijay Dasmi, depending on where you're from and what you're celebrating today. It's a really good day for us to have a conversation on new beginnings, conquering some difficulties, and we basically wanted to do a session where we talk specifically about what Sphere does, which is different from other products that are available with similar mandates, as well as other portfolio management services that you may be considering investing into. So happy to take any questions, anything that's on your mind. If you want to understand more about multi-asset investing, please feel free to keep the conversation going. We'd like to keep the webinar as interactive as possible. And so without further ado, I don't want to keep the people who are here waiting. Let me get started on today's webinar, right? So I think the first and possibly the most important thing in terms of what makes us different from other products as players in the industry is that we really understand investors. And what we mean by this is that it's not just about knowing what investors want, it's also about understanding their mindset, right? So today, when you talk to people who are entering the markets or who have been market veterans for some time, they do understand how equity works as an asset class, meaning pretty much everyone identifies as a long-term investor. People do have higher return expectations, but their holding periods have actually increased in the sense that even someone who's doing a very aggressive equity investment today, their justifications are along the lines of, you know what, I'm a long-term investor. I don't need this money for the next 10 years. I know that there'll be ups and downs in what's going on, and I'm okay with that. And that's a great attitude to have because it opens up the door for um, long-term wealth creation. But the other thing that is true of all of us is that we want better returns at lower risks. Nobody actually enjoys the volatility that comes into their portfolios when they take much more aggressive strategies. At the same time, no one really wants to miss out on returns. So it's almost like we are willing to put up with volatility simply because there's a promise at the end of that timeline. And investors today are more and more savvy, by which we mean they're looking for more exotic solutions, they're looking for more sophisticated investments, they want to participate in different things. And at the same time, given where we are globally and macroeconomically today, I think everyone wants a large slice of the India story. It's not that you're looking for flavors elsewhere. You really do want to participate exactly where India is and keep that orientation in a portfolio so that we are capturing probably one of the best economic fundamentals in our investing. So this is where our mindset is today. And we do understand that this is what investors are looking for. And that's exactly how Sphere is constructed as well. So if we look at performance, right? And I think the most important trade-off in this conversation is that people think that if you take a lower risk approach, you have to compromise somewhere on returns, which is actually not the case. And I want to talk about this with numbers because I don't want it to just be something that we're saying. And this is actual performance. So Sphere has had roughly a 2.5-year journey so far, and we'll complete 3 years in December. So if you look at our performance since inception, we've been above 25%. Our 2-year returns have been close to 35%. Our 1-year return has been close to 45%, or above 45%. And if we look at peers, we're actually ranking number 1 across all of these things. And we benchmarked against a pure flexi cap fund because our allocations towards equities at the scheme level today is much higher than what we would expect for a multi-asset fund at this point in the market context. You also have benchmarked against one of the best multi-asset funds in the industry. And we've looked at a multi-asset index as well as a pure large cap index. So against all of these benchmarks that we've set, we are actually doing quite well against them. And so this is the return component, right? We've talked about how we're performing in this context. And it's not that investors need to compromise on returns when they're looking at a multi-asset solution, but also walking you through our September performance. And but the more important thing is like, okay, am I doing all of this performance at an extra risk level that the investor has to take? Because then we're back to that same dynamic of higher risk, higher reward. And the answer to that is actually that we are not. Because if we look at our performance on drawdowns, we actually stand much better than a pure equity index. And we aren't too much further away from, say, something like a multi-asset index. So our deepest drawdown happened in 2022. And this was when the Nifty sort of corrected over a period of a month. And from there, Sphere actually didn't do too badly. We were a much smaller fund at that point. The multi-asset index naturally had a lower drawdown, given that there was more allocation towards fixed income and arbitrage at that point. So this is what our largest drawdown has looked like. So we're somewhere between a pure passive sort of multi-asset index and a pure equity index like the Nifty. So you're not actually taking that much more risk for that same kind of reward that you're seeking. So I think the second and most important characteristic that sort of differentiates us from other product solutions is that we actually provide solutions. And if we look at what investors need today, right, I think the idea is that people want something where they can save regularly, where they can avoid or minimize their losses. They can compound in a more steady and regular manner, and they're able to invest at the right things in the right time. Right. And this last thing actually proves to be quite tricky because we don't really know when to pick our ideas or when to participate in a certain thing. And the more sophisticated we become as investors, the opportunities or the options actually keep growing. So when it comes to having a structure towards your portfolio, what tends to happen is that you participate where there is a lot of visibility. You participate where there is a lot of communication that's coming from other product providers or from the market signals itself. And typically, when we chase performance, we don't actually see the best results. So we need to look at a different way of finding the right time and the right place to participate in. So when we start looking at this, you realize that multi-asset investing actually allows you to save regularly because you don't need a specific context to participate. So if you're looking at something like a pure equity fund, you're always going to look at valuations and then look at bottom up and top down factors to see whether it makes sense to participate at that point. Whereas in multi-asset, because you have uncorrelated investments within one portfolio, there's always going to be something that is in the phase where it's going to grow and perform. There's always going to be something that is performing, and there's always going to be something where you have to shift out of. So because you have these three phases working together across different asset classes, you don't really need to worry about, oh, should I wait for the market to correct? Should I wait for this to happen? Should I wait for that event to occur? It allows you to just save when you have the liquidity. At the same time, because these assets have lower correlation amongst them, that actually means that your probability of your whole portfolio drawing down at the same time kind of reduces, or even when the drawdowns happen, it's not going to be so pronounced because some assets are moving in opposite directions. So you get that cushion, and this, of course, ensures that you're compounding regularly because you're participating in all of these asset classes at the same time. So this is, I think, the secret to multi-asset investing. And it's what we like to call asset allocation, because you get to participate in a wide variety of things, and they work out for you in wonderful ways. So another common misconception that investors seem to have is they spend a lot of their time. So when we look at Q&A from webinars, when we look at the kind of questions that investors ask us, it's always about, should I buy this fund? Should I buy that stock? Should I do this at this point? What do you think of so and so? And we spend a lot of time on security selection, that is choosing where we want to participate. Right? But how much does security selection actually play a role in differentiating our returns at the end of the day? So there was a really good study that was done known as the BHB study, where they looked at what are the factors that actually contribute to differences in returns. Right? So let's say you have a particular portfolio and I have a particular portfolio. Then why, and we've started investing at the same time, then why are my portfolio returns different from yours? And it turns out that the stocks we pick or the securities that we choose contribute only to about 5% of, making difference to our returns. And then timing the market actually doesn't play a big role at all. It's less than 2%, which essentially means that, the amount of time that we spend on deciding whether this is the right time, or if we should wait for markets to correct before we participate, or if we should hold off, or, if we should put money in now, the amount of time that we're putting into that only contributes to about a 2% difference in returns, right? So that explains why our returns are different 2% of the time. So where is the bulk of this actually happening? And when we look at what causes 90% of return variability, it is actually asset allocation. And we don't spend enough time discussing asset allocation, prioritizing it, or even trying to figure out how it works for us. Asset allocation is something that tends to take a back seat, and it's like, oh, maybe I should have some fixed income at this point in my portfolio, or maybe I can trim down some and keep money in cash. But asset allocation, that is the amount that you keep in each of these asset classes, actually contributes to 90% of return differences. So when that is the case, we should actually give that more importance and reduce the amount of time that we're spending on choosing investments as well as timing the market, right? So this is, I think, our key takeaway, because this is the most powerful wealth creation tool that you can have. So spending time on deciding where you want to invest is actually going to make a huge difference to how your investments perform. So now let's kind of look at what's happening behind the scenes. Where is the magic actually? And when we try to break that down, we need to understand why is it that asset allocation works. And it's pretty simple. So let's take a look at how this chart is structured. You have the years from 2010 to 2023. So 14 years of performance. And whatever the best performing asset class of that year is at the top of the table. And whatever the worst performing asset class of that year is at the bottom of the table. So when you look at this table, what you're going to realize that beyond the colorful sort of chart that this is that the colors on top keep changing every year, which basically tells us that everything can be a winner, but everything isn't a winner every year, right? So the same asset cannot perform year after year after year after year. It can perform in phases, and then it's going to go through phases of underperformance, right? And this is what you look at in terms of correlation. So correlation basically means that, okay, if one asset class is performing, is the other asset class also performing, and to what extent? Are they moving in the same direction with the same sort of momentum, or do they have slightly different paths? And it's actually good for asset classes to have different paths in your portfolio, because this essentially ensures that you are able to sort of navigate different market conditions and allow different things in your portfolio to bloom at the right time. So now I'm going to walk you through, so pay some attention to this chart, because I'll walk you through our three big takeaways. The first of which is that there is no year in which everything fails. And the second is that half of the time, all of your assets actually work for you. And the third is that losers and winners are interchangeable, right? So I'm just going to quickly go back to this chart and show you what the lessons are. So if we look at the first one, which is that there's no year in which everything fails. So let's take the worst year for small caps, which was in 2011. So your small caps drew down about 35%. So they lost more than 1/3 of their value. Your mid caps also lost nearly 1/3 of your value. And your large caps, that is the safer equity assets in the market, lost about 1/4 of their value. Global equities did not perform this year. Your fixed income also didn't give you too much, with your government securities giving you a measly 4%. And then you have your debt, which had given you roughly an 8% return. Real estate did really well, giving you, so real assets, that is both your real estate and your gold, actually did phenomenally well in 2011, right? If you expected the same kind of performance from gold in 2012, that did not happen. If you expected the same kind of performance from small and mid caps or large caps, that did not happen. The next year's winners were actually small, mid, and large caps. So this is what we mean by losers can become winners, winners can become losers. You can't expect the same thing to work out every year. So this cycle keeps going on. So when you see that one part of your asset class or one part of your quilt is actually not performing, there is another part that makes up for it, right? Your conservative investments can't really do too much for you. You can't expect, say, a fixed income return. If you have mark to market and duration gains on your side, maybe a 12 to 15% is reasonable as an expectation. But if you don't have that, right, then you can't expect more than a 7 to 9% return on these investments. So we need to be careful about where we anchor our expectations, and we need to be okay with the fact that certain years are not actually going to give you phenomenal double-digit returns. And when we're okay with that, we'll realize that there is merit in moving monies across asset classes, because it allows us to participate in different things at different times. So these are the three key takeaways from our chart. and our basic thesis as to why multi-asset investing actually works for everyone. This is not about what your risk appetite is, what your return expectations are. It's not about whether this is the right you to start investing. This is basically about the fact that we need investment solutions. We need investments that we can continuously participate in. We need investments that give us confidence to stay invested. Because after a 35 or a 40% drawdown, very few people want to stick around and see what comes next. And sometimes those drawdowns can actually be a lot more sustained. It needn't be 1 year. Many of us may have the patience to withstand one bad year of returns, but how many of us can actually put up with 3 bad years of returns? Not all of us have that luxury. Not all of us have that mental preparation to actually go through such difficult phases in the market. And I think that's why a lot of investors also warn you about valuations and the risks, because essentially the question that we need to ask when markets have been going in one direction is that, okay, can this actually sustain for longer? And what if it goes the other way? Am I willing to miss out on the downside or the upside from what comes from here? So history is a great teacher, and I think it makes sense for us to look at this chart over the weekend, spend some time. It's published by Livemint, and I think every year they publish a quilt which shows you how these asset classes are performing. And it's a great way for us to sort of reflect as to what really works for us as investors. So coming back to Sphere, what is it that we do differently? We run a top-down strategy. So if I look at what the weather is today, there's a lot of talk about how, I think the latest non-farm payroll numbers came out in the US. So the US economy slowing down or like going into a recession, or the whole soft landing conversation is back on the table, whereas a month ago when the Fed cut rates, that was not the case, right? So there is this expectation that the world, that the global economy is actually doing much better than it is. There is this sort of, until the last week, 10 days, you've had a lot of FII flows come into India, both on the fixed income and on the equity side. You've had some resilience in global economic activity. There's been a lot of progress. If we look at where we were with respect to inflation 2 years ago in 2022 versus where we are today, there's been a lot of progress that central banks have made on that front, and they're ready to actually pivot and change their stance, change their policy structure so that they can move to a more conducive environment for growth. And we've had a lot of faith in how corporates are performing today, right? And it's, as well as market participants, have been quite risk on with their investment allocations. But the question that we have to ask as top-down investors, and it's something that we are asking, which reflects in our portfolios as well, is that what if the weather changes, right? What if global growth isn't all that it's trumped up to be? And when growth slows down, let's not forget that we have a huge conflict that's happening in the Middle East. You've had oil climb back. You've had OPEC continue to announce production cuts. Oil coming back to $80 a barrel. You've had FIIs start pulling out money from our markets. You've seen gold rise up. And actually, if you have the US cut in interest rates, the FII preference for safer haven assets is going to move towards dollars as well as gold. So we need to think about these kind of undercurrents that are there in global markets. At the same time, when we look at historically how inflation stories have played out, it's not that simple, right? When you get to a point where you have high inflation, a few rate hikes are not going to cut the story. What tends to happen is that you have phases where inflation comes under control. You have phases where it goes out of control again. And in today's context, even if we go back to commentary from the RBI governor's speech earlier this week, the thing that really stood out is that they said that we are worried about inflation. Yes, our stance has moved to neutral because we've made progress on a lot of parameters, but we are worried about inflation because of geopolitical tensions, because of climate, because it's been so unpredictable, and also because of global commodity prices. Global commodity prices have actually shot up quite a bit. So the RBI is worried about inflation. The Fed is also worried about inflation, but they're more worried about unemployment. That's the context that we have to take out of global commentary. And when we take a hard look at how corporates have actually performed, they have missed earnings estimates, right? And a lot of investing is happening based on P&L numbers and not so much on balance sheet. And balance sheets are important because when the cycle turns, you actually need the balance sheet to protect you from what you're going through. The P&L is what we look at as parameters in good times, right? And now coming to the last point, which is that the markets can become risk averse. It definitely doesn't seem that way today. You are seeing a lot of money come in to the mutual fund space through SIPs. That those flows have actually been relentless. So, am I being a little bit too doomsdayish and saying that markets could become risk averse? No. The simple reason being that if you even look at the SIP flows, the SIP stop numbers have actually gone up, which shows something very important, which is that investors today are lacking conviction. They are lacking the ability to stay invested in a particular theme beyond 2.5, 3 years. And this is while there is performance. Now, if there is a phase where there is no performance, what do you think could happen? Most of the investors that are there in the markets today have entered in the last 3 to 4 years, which essentially tells us that many of them don't have experience in weak markets. They don't know what it's like to face a portfolio drawdown. They don't know how they are going to prepare for a scenario where their portfolios are in negative territory. So when we're in this context, when we're participating along with these other participants in the market, we really need to take a step back and think about how we want to tackle all of this differently. And this is why the top-down approach actually matters, because when we're looking top-down, it gives us a broader picture of how people might behave, how markets might move, and where the risk rewards are shifting. So that leaves us with the question whether equities are still a safe place in today's market. So if we look at the history of investor behavior, we need proof before we put our money in front of us, which means that buying tends to happen in the later phase of performance. That is, there needs to be sustained performance before more buying occurs, and there's more buy-in from a lot of participants. Similarly, many of us tend to hold on to losers, and this is a known behavioral bias because we're waiting for the tide to turn, or we want to recover at least our initial cost. And when that happens, we tend to sell only when we lose faith or confidence, or we tend to avoid participating in the future. So the outcomes from this kind of behavior without a top-down view is that you tend to actually lose out on wealth creation, and you tend to presume more risk in your investment strategy. So we need to kind of work in a different manner with the same cycle in place. And that brings us to the third reason why Sphere is a really powerful tool for you to create wealth. The key thing being that we are contrarian investors. And this matters a lot. And I have a very interesting data point from Bandhan Mutual Fund, where they looked at what happens when investors chase performance, right? So we saw our big colorful chart from LiveMint where you had each asset class wise performance for each year. And we talked about how losers become winners and winners become losers. So this is about chasing performance. So imagine you have 4 years, W, X, Y, and Z. And in year W, A is the best performing asset class. In year X, B is the best performing asset class. In year Y, it's A again. And in year Z, it's a new asset class known as C. So if we are chasing performance, what tends to happen is that an investor in year X, instead of participating in asset class B, which is going to be the winning asset class, will prefer to participate in A, where there is already established performance. So similarly, when we move to year Y, what tends to happen is the investor will pick asset class B because it's already given them some track record of how well it can do. Then when we move to year Z, instead of looking at the new asset class C, we're still hung up on A because it did really well in year Y. So when you do this equal weighted, so it's an experimental portfolio. Let's say you had an equal weight across all of the assets in this portfolio. When you chase performance, your returns are roughly around 7.5%. And when you actually take a more equal weighted and rebalanced approach, your returns improve to almost 9%. Right? So there's a 1.5% compounded differential that you can earn by just making no judgment call. But if we improve our judgment and we play a little bit more contrarian, then those results can actually be much better. So I want to give you an example of one theme that we have played with a contrarian mindset and a value investing mindset, because these are the two most important philosophies that we run our entire PMS product suite in. So we were looking at public sector banks in 2020, 2021. And this was at the back of some major reforms that had happened in that sector, right? So you had the insolvency and bankruptcy code come in. You had the NCLT getting set up for debt recovery. Prior to that, the RBI had been super strict with banks, asking them to report NPA numbers, being very cautious of the reporting as well as the provisioning that was happening, right? At the balance sheet level. So when provisions started to improve and defaults started to come down, and because the provisions were higher, the protection for the investor was also higher. You saw the balance sheet actually improve. And in addition to this, the government had also committed to recapitalize the public sector banks. They looked at rationalizing the entire public sector bank space through mergers and consolidation of the industry. So when this happened, you actually had a set of banks that came out of a very difficult phase with better balance sheets and more capability and better risk management practices. So from a logical standpoint, it clearly meant that things were only going to get better and not worse. So when we started looking at this in late 2021, we noticed that the return on assets and the return on equities were bottoming out. We realized that the perception around public sector banks was very bad. So people would tell us, "Oh, have you ever been to a public sector bank? Do you know how long it takes to get anything done? Are you really betting on this economic growth from this kind of environment?" And we thought that, okay, like, sure, there is some validity in that argument, but when there is so much negative perception around something, it makes sense to look at it again and see whether there is any truth to that, or if there could be another side to that story, right? So when we looked at this, the recapitalization was actually the big reform driver, because recapitalization ensured that after this period of stress, these banks were actually had capital to grow and perform in the coming cycle. So from a valuation perspective, we were very comfortable because you had price to book for some of these public sector banks trading below 1. And there was a stark difference between the kind of valuations public sector banks got and private sector banks got. And that difference in valuation was not fully justified. So our expectation was that, okay, now they have capital, they've gone through this really difficult period, so that so they're going to actually be way more careful in the way that they're lending. From a regulatory perspective, they have to create more provisions to make sure that this works properly. And you're expecting another phase of growth. So we felt that it made a lot of sense to actually look at allocating to public sector banks at a point when nobody else was really considering them as good investments. So this journey of investing was roughly 1.5 years. With a little bit of profit booking towards the end of December 22, when the entire lot ran up for a bit. And then we had a phased period of exit over, say, 6 months. So moving on to the next thing that makes Sphere special and Sphere different is that we actually go the extra mile when it comes to your investing. And what do I mean by that? So let's look at a traditional multi-asset investment solution. There are allocation limits. So if you look at how certain mutual fund categories operate. There is a requirement to get a certain favorable taxation treatment or a certain favorable return profile, which means that there's necessarily a higher allocation to equity investments. They tend to be so now with the budget sort of rationalizing everything except fixed income. This tax efficiency part is something that maybe not as big an advantage as before. The ideas in traditional funds tend to be more vanilla, right? They're all safer, they're all very similar in nature. Whereas when we look at how Sphere operates, you see a lot more investment flexibility. The mandate allows us to go 0 to 100% within any particular asset class. We are tax conscious, and that means not only do we look at investments that are taxed more efficiently, we also look at how to ensure that investors have a longer term focus and we don't churn the portfolio too much. And when we do this, we allow that compounding to stay in and we reduce tax incidences that an investor has. At the same time, there's a lot of out of the box thinking. I explained our contrarian philosophy with one example, but there are surely many others, and those who have been part of our journey or who will be part of our journey will definitely experience how contrarian investing actually helps them deliver on performance and manage risk so much better because we're conscious of valuations. And before we end, I'd just like to say that actually getting started is quite easy. We are a SEBI registered PMS, and due to our registration with SEBI as well as regulatory requirements, the minimum investment for any portfolio management service is 50 lakhs. We are benchmarked against the NSE Multi-Asset Index 1. And what makes us particularly investor friendly is that there is no exit load. We do encourage people to come with a 5 to 7 year investment horizon in mind, simply because that allows them to experience a good market cycle, right? You get to see different phases, you get to see how assets work together in your portfolio. That experience can actually be quite liberating and help you develop a sense of confidence in investing and wealth creation. But there is no exit load, meaning we'd like investors to feel free to participate. And if they have any liquidity constraints, to also be able to exit as they require. From a fee perspective, we have a flat fee of 1.5%. So you don't have to pay anything in terms of performance if we do better than our targeted return. So as a multi-asset fund, we aim to deliver returns somewhere between 12 to 15%. I'm sure those of you who saw our slides at the beginning of the presentation would have realized that we far exceeded those returns. So as an investor, when we perform much better than expected, those returns are with you. We don't actually take any part of profit sharing. So, and we've got a track record to show that we can actually do better than the benchmarks that we set. But that being within our risk management framework, we would never take excess risk to deliver that excess return. We're always focusing on managing risk effectively in the portfolio. And if the returns come from that risk management framework, we're happy to deliver it for investors. Like I mentioned, it's a truly flexible mandate. You can see that we can go between 0 to 100% for anyone. With respect to suitability, Sphere actually suits a wider range of investors because it offers very decent returns at a very reasonable risk level. So this is not a conservative investors product. It's not something that aggressive investors need to avoid. So wherever you are on the risk profile spectrum, I think Sphere can work for you. Especially in today's market context, it can complement a lot of the other investment decisions that you have made and can be a very powerful tool in your wealth creation arsenal. So it's something that you can easily consider. We have a very renowned fund manager who's running this product. So all of you must know Shyam sir. He's been a market veteran for more than 3 decades. He's known for his value and contrarian investing style, and he's quite visible on all of our social media channels. So I'm sure you've had a lot of opportunities to experience Shamsa's knowledge and acumen in markets. Over and above this, I think we should also look at the kind of team that works behind all of our PMS products. So if you're not looking for something on the multi-asset side, there are many other products that we offer, which actually caters to every kind of investor. So we have Solitaire, which is our flagship portfolio, and we recently completed 5 years. It's a multi-cap fund or a flexi cap fund, actually, because the core objective of Solitaire is to invest in market leaders. And then we have True Blue, which is a pure blue chip portfolio for somebody who's definitely on the more conservative side, wants high quality investing only, then True Blue is very suitable for that objective. Then, of course, we have Vriddhi, which is our small and mid cap portfolio. So, for someone who's seeking a more aggressive or who's seeking exposure into these themes, should definitely consider Vriddhi. And beyond that, we have Sphere and Neo, our multi asset PMS schemes that cater to residents and non residents. And finally, with that, I think we can open up to questions. So I'm happy to take anything that you have on your mind. If there's anything that you'd like to know more about what we do, about multi-asset investing, I'm happy to answer all of that at this point. Please feel free to type in whatever you want in the chat box or in the Q&A section. If you're interested in knowing more about Sphere, or if you want to have a more detailed one-on-one conversation, please feel free to write to us at 9500027285. Our team is very active on WhatsApp and would be happy to address anything that you have. Gopi, if there are any questions from YouTube, you can post that as well. Thanks. Thank you, sir. That's very sweet of you. I'd also like to thank everyone for coming today. Happy Vijayadashmi. It's not easy to spend time on these kind of projects on a day when you're at home with family. I'm grateful to everyone who could make it today. Yeah, no problem. I am working abroad, need to go for wealth creation. Is that what it is, Gopi? Yeah, if you're an NRI and you want to participate in a product like Sphere, we have a separate PMS strategy known as NEO, which is the NRI investment opportunity. And you do get a flavor of multi-asset investing from there. And you can start off with Neo. 100% today, we are quite confident on the multi-asset side because there is a certain level of risk that is there in equity markets, which many investors may not be ready to take on that risk, right? So, of course, it's one thing that people are willing to take that risk, but many of them don't understand what that risk is that they're going to get into. So, yes, I think Neo would be perfect for you if you're an NRI, and that would work. So if you're keen on knowing more, you can just send us, Gopi, you can please share the WhatsApp number on YouTube so that they can drop a message directly and we can get in touch with you. Someone from our team will actually walk you through the entire process. A 5-year horizon. So like I said, for a product like Sphere or Neo, ideally, we would recommend that people come with a investment horizon of 5 to 7 years, because that would give you enough time. If your timeline is closer to the lower end of that and 5 years, I think it's still a great option for you. Gopi, this you'll need to share on YouTube, I guess. We still have about 10 to 15 minutes left on today's webinar session. So any other questions that anybody else has about the product, about suitability, then I'm happy to address that. So I'll give it another 2-3 minutes. If we get any questions, I'm glad to take it. If we don't, then I would just like to thank everyone for joining us today and being part of this presentation and discussion. I hope we'll be working with you soon in the future in some capacity. Uh, there's a lot that we do at ithought. Uh, we have, as I mentioned, a few products on the portfolio management side. We also work very closely with smaller investors through the mutual fund route. We have a very interesting program called Milestones to Wealth, uh, where we are working with investors from wherever they are to their first crore in savings. So, however you identify as an investor, whatever your aspirations are in this journey, I'm sure ithought can find some way to add value to your journey. So, please feel free to reach out to us and look forward to seeing you soon. Sure, Gopi. Definitely. That is not our approach. Let me just repeat the question. If I invest the minimum of 50 lakhs to PMS immediately, can you deploy all the money at one time? Uh, See, we don't follow a model portfolio structure and we don't believe in deploying everything on day one. We are very careful because we have a very strict valuation approach in terms of allocating into ideas, which means that if something is in our valuation comfort zone, then we will participate in it. If not, we will either wait till it comes back into the zone to participate, or we will look at other things that fit into that framework of risk and return management. So that is the basic thing. If the minimum that you have to start with by SEBI regulations is 50 lakhs. So you cannot give us 40 lakhs and then after that is deployed, give us 10 lakhs. You would need to give us 50 lakhs regardless of how much we are deploying on day one. Then that rest gets invested as and when those opportunities arise. And the 50 lakh requirement is the is a SEBI requirement. We cannot start investments with anything below that. I hope that answers your question. Anything else from YouTube, Gopi? Okay, great. So then I will just close it for today and I'll be ending the webinar for everybody in the meeting room now. Thank you for coming and thank you for participating with us. We look forward to seeing you soon.